Warren Buffett. You've heard the name. For well over half a century, he's been the undisputed king of investing. But how does he really do it? What's the secret sauce? Well, today we're diving deep into the 7 core secrets from the book Warren Buffett Gibi Yatırım Yapmanın Sırrı to really break down his legendary approach. Let's get into it. Everything, and I mean everything, starts right here. And it sounds so simple, doesn't it? But this isn't about never taking a risk. Oh no, it's about intense discipline. It's a mindset that forces you, before you do anything else, to protect your money. It's the bedrock of his entire philosophy. And here's the other side of that coin. Buffett is teaching us to step off the emotional roller coaster of the market. You know when everyone is piling into the latest hot stock, screaming about how it's the next big thing? That's your cue to be cautious. And when everyone is panicking, selling off perfectly good companies, well, that's when you start looking for bargains. Okay, but before you can even dream of buying stocks, you need the fuel for the fire, right? You need capital. And that brings us to our very first secret, the one that makes everything else work. You have to build a saving habit. It's the most basic rule, but honestly, without it, the greatest investment strategy in the world is totally useless. And this is the big one, isn't it? This is the question that stops so many people dead in their tracks. The whole idea of saving can feel just huge, especially when you've got bills to pay. But the key isn't about starting big. It's just about starting, period. So how do you do it? You make it a system. You take the thinking out of it. The first way is the 10% rule. Just set up an automatic transfer for 10% of your paycheck the day you get paid. If that feels like too much right now, no worries. Try the increasing savings technique. Start tiny, whatever feels easy, and then just nudge it up a little bit each week. The trick here is automation. It's your best friend because it builds that muscle of consistency without you even trying. Okay, so you've got your savings machine running. Now we can get into the really juicy stuff. The next 3 secrets are all about getting inside Buffett's head and learning to think like a value investor. This isn't about chasing hype, it's about understanding what something is truly worth. So, this big idea of value investing, it came from Buffett's own teacher, the legend Benjamin Graham, who wrote The Intelligent Investor. The entire game boils down to one simple goal. Figure out a company's real, fundamental value, and then you wait. You wait for the market to give you a chance to buy a piece of that company for way less than it's worth. And honestly, this is the perfect way to think about it. Imagine I offered to sell you dollar bills for 25 cents each. How many would you buy? You'd buy every single one you could get your hands on, right? That's the exact feeling you're looking for when you find an amazing company that the market is just temporarily down on. But how do you find these companies in the first place? Well, Buffett's answer is brilliant. Start with what you already know. He calls it the circle of competence. He famously doesn't touch industries he doesn't get. Because, let's face it, you can't figure out the true value of a business if you don't even understand how it makes money. So how do you find your circle? It's probably easier than you think. Just ask yourself these 3 simple questions. What are your hobbies? What do you love to do? Where do you actually good at, professionally? And what products or services do you already spend your money on? The answers point you right to the industries where you already have a head start. All right, so you're looking within your circle. The next thing you're hunting for is a company with a strong economic moat. And yeah, you should think of it just like a moat around a castle. It's some kind of durable advantage that protects the company from competitors, allowing it to keep making money year after year, even when times get tough. And the difference between a strong moat and a weak one? It's night and day. A strong moat is like an iconic brand, think Coca-Cola or Nike, or a massive low-cost advantage, like Amazon. A weak moat, on the other hand, is fragile. Remember Nokia? They were king of the world, but one big innovation from a competitor, the iPhone, and poof, their moat just evaporated. Okay, we've got the mindset, we know how to think, now we need the tools to actually do the work. These next 2 secrets are all about the investor's toolkit, learning the language of business so you can calculate what a company is really worth. Now, don't let this part scare you off. You do not need to be an accountant, I promise. You just need to understand the story that these 3 documents tell. The balance sheet, that's just a snapshot of the company's financial health. The income statement tells you if it's actually profitable, and the cash flow statement, this one's crucial. It shows you where the real hard cash is coming from and where it's going. Let's make this real with our fictional Amit's tomato paste company. We glance at its balance sheet and see the debt-to-equity ratio is 38%. Awesome, that's well below the 100% danger zone. Then we check the income statement and find the return on equity. Whoa, it's 52%.
I mean, anything over 15% is considered really strong, so this is fantastic.
And now, for the ultimate value-finding tool, another gem from Benjamin Graham, the net-net method. This is really the heart and soul of finding those deep bargains. It's basically a way to calculate what a company would be worth if it just shut its doors today, sold everything off, and paid all its bills.
Let's walk through it for Amit's company. Step 1, we find the net current asset value. You just take the current assets, subtract all the liabilities, and that gives us 50,000 TL. Simple enough. Step 2, we figure out what that's worth per share. We divide that 50,000 by the 20,000 shares out there, which gives us a liquidation value of 2.50 TL for each share. And now, for the magic, step 3, you apply a margin of safety. Graham was adamant about this. You want a discount. So if you can buy that 250 TL share for around 160 TL, ding, 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 you found a real bargain.
So you did it. You found a great company and you bought it at a great price. Now what? Well, the final secret is all about how to manage your investments with patience and discipline. It's about building a portfolio that can actually last. Now, this quote always makes people do a double take. What Buffett means is that if you've done an insane amount of homework and you're supremely confident, maybe you don't need to diversify as much. But let's be real. For most of us, diversification is essential. It's our safety net because nobody, not even Buffett, is right 100% of the time. So here are 5 rules to live by. First, decide how much cash you want to keep versus how much you invest. Second, and this is a big one, never put more than 10% of your entire portfolio into one single stock. Third, rank your investments based on how confident you are in them. Fourth, check in on your companies, not the stock price, the companies, at least once a year. And finally, and maybe this is the most important, don't panic sell just because the price drops. If the business is still great, a lower price is an opportunity, not a reason to panic. This chart right here shows you that 10% rule in action perfectly. See how no single slice of the pie is too big? This means if one of your companies hits a rough patch or even fails, it won't sink your entire ship. You aren't putting all your eggs in one basket. Whew, okay, we have covered a ton of ground here, right? We've gone from the simple act of saving money all the way through the mindset and the tools of a master investor. Let's bring it all home. So here it is, the whole journey laid out as one clear path. It all starts with building that saving habit. From there, you adopt the value investing mindset. You stay within your circle of competence to find companies that have a strong economic moat. Then you pull out your toolkit, reading financial statements and using the net-net method to find the real value. And finally, you manage it all with patience and discipline for the long run. Look, this framework is not a get-rich-quick scheme. It's a proven, powerful blueprint for building wealth steadily and intelligently over time. You have the knowledge now. You have the map. So the only question left is, what's your first step going to be?